Delighted today to be introducing John White from JBW Consultants to go through with you what members have been asking for. So these are areas around which members are looking for information and support. We access or we connect with members via our survey, via text, email, phone. Our staff in the office make phone calls directly to members and have done at least 3 rounds of that since the start of COVID. And so we engage fully with members to find out what your needs are and where the questions you have are, where the questions you have about supporting your business. Recently, obviously, it's all about cash, stock, costs, Brexit, and obviously grants as well, and a number of which were announced during the budget, but they're quite unclear and the information is only being issued, over the course of time. So it's wonderful that John can be here and can decipher an awful lot of that information from us. Because this is a webinar, you're invited to put any questions you have in the question and answer box just on the bottom of your screen. And then when John is finished with his presentation in full, we can go through the questions. John wants to have you at your lunch table, and so will be efficient about his delivery as always, but also very thorough, and we're delighted to have him. So I won't speak any further. I'll leave John do the talking. Thanks, John.
Great stuff. Thank you, Jenny. Hope everybody can see me and see the screen, because that's how these things work. Thank you, Jenny, for the invitation, first of all, to present to you on some of the topical issues. And I know that you've done surveys with the members, and there are some critical issues that I suppose some members are suffering from at the moment. For those of you who don't know me, that's a wonderful list of all the services that you'd expect your account to do, and we do. So we're fully regulated. We're here on Church Street, coming up on 19 years actually. So time does fly when you're having fun. So what have we been asked to look at today? As Jenny mentioned, there has been a number of schemes announced, particularly over the summer and more recently in the budget. And there's been a lot of detail behind those schemes that the politicians tend not to announce. So I typically describe it as the carrot and stick issue. So the politicians announce the carrot, they hand it over to revenue, and revenue add the stick. And in some of these schemes, there's a fairly thick wedge to the stick. They tend to complicate things. Perhaps there's a rush to get them out. But you'll see in a moment the context of where we've come from with change. So what we're hoping to touch on today, and I'll go through it reasonably quickly, and leave time for questions and answer. But I would hope to get people at their lunch tables. For those who are having lunch at the moment, I'll try not to give you indigestion. So we're going to touch on the CRSS, or what's becoming affectionately known as the CRIS scheme. We're going to just take a look at some of the changes around debt warehousing announced in the budget. And if we have time, we'll cover off some of the cash management issues that people are saying they're having issues with. And just an area on governance I want to touch on, because it is starting to become real for those businesses that may be getting into difficulties later on. Where are we coming from? A lot of change in the schemes that businesses are availing of at the moment. You can see from the slide there in front of me that the original scheme, which was the TRSS, had 17 revisions over a 4-month period, and the existing schemes are fast catching up. The eWiz, as revenue are calling EWSS, has had 4 revisions so far, the most recent one there to the end of October. Warehousing has been edited in the recent budget, so we'll get 5 revisions on that. And CRIS is only 10 days old, and we've already, up to 2 days ago, we've had our 3rd revision. So if people are availing of these schemes, they need to keep an eye on the changes and talk to the accountants before jumping in. So CRIS, what is it? CRIS is a support for businesses who effectively have had to close their business or stopped trading during the current lockdown. So I'm using the phrase lockdown. A lot of the guidance that is in the revenue guidance is referring to restricted periods. And they refer to restricted periods from level 3 up to level 5. And depending on what level restriction is on particular counties, certain businesses are closed. So I'm just using the phrase lockdown because I think it's easier probably just to lessen my mouthful. The CRIS scheme is a cash fund that will be available to those struggling businesses right up to the end of March 2021. There is a requirement, and there's a number of requirements in fact, but there is a requirement to have a premises and be operating your business primarily from a premises. And either you must prohibit access to that premises at the moment, or significantly restrict that access. And we'll touch on in a minute what revenue mean or what they say in their guide as to what is a significantly restricted access to a premises. We've had a lot of inquiries around this reference to Schedule D, Case 1 trades. What is it or what isn't it more particularly? So a lot of businesses are going to fall outside of the scope of CRIS. Why? Because they're not Schedule D, Case 1. I've just listed a few examples there. So professional services, the likes of ourselves, accountants, solicitors, opticians, estate agents will not qualify for CRIS because they're considered to be professional service. Obviously, the landlords, charities, sports bodies in the guidance that came from Revenue 2 days ago has basically said that charities, sports bodies, because they're exempt from taxes equally, are not entitled to CRIS. So there's a requirement to have a business premises. So if you're a tradesman and you drive around in your van, you don't have a business premises that the customer accesses. Typically, you go to the customer. So again, you will not qualify for CRIS. So when you start ticking all the boxes here, you'll realize that CRIS is really for the high street traders whose premises have had to close or substantially close during the current lockdown period. What is it? As I said earlier on, it's a cash payment. So we've yet another acronym. I want a dictionary to go with all of these one of these days. So it's a cash advance for businesses towards expenses. And the reason that definition is in there is because it's not considered to be turnover, so it doesn't have a VAT issue. It will fall below the line in your profit and loss account, effectively as a minus showing up in your expenses. When we talk about restricted trading, Revenue are saying that your turnover should not exceed 25% of your 2019 average weekly turnover. So there's a couple of issues in that businesses will have to go back. Those that prepare accounts on a March or an April or a June basis and apportion 2 years accounts to find out what their turnover was on a calendar basis for 2019. How much are you going to get as a cash rebate? 10% of the first €20,000 a week and 5% after that. So for businesses up to 4 million odd, 4.16 I think it is in turnover, will be able to get the cash payment from Revenue. There is a cap on the maximum amount that you could receive weekly, which is €5,000. And we'll look at an example just in a couple of minutes of that for those that are struggling to get a head around those figures. And the bad news, with all these monies that you've been receiving, there is a tax implication. And in this case, the business will be taxed on receipt of those funds in due course. So when your accounts are prepared for the relevant year, that will be effectively a trading receipt. From an eligibility perspective, how do you qualify for for CRIS? First of all, you must have an up-to-date tax clearance cert. For those of you who don't know whether you have or haven't, or may not have applied because there wasn't any reason for you to apply for tax clearance cert, you need to log on to your ROS account. In the top right-hand corner, there should be a box up there telling you whether or not you have a current valid tax clearance cert. And if you don't, click through the link, follow through, and if your tax returns are filed and paid up to date, you will get your tax clearance certificate straight away. It literally just gives you a code. For those of you availing of warehousing, and there is just a little bit further on that presentation details of the warehousing. So for those of you who have filed returns that have not paid those taxes in the current year, that will not affect your ability to get a tax clearance certificate. There is a requirement to be compliant with the VAT legislation. And for those of you who are registered with VAT, that means not alone to have filed your VAT-3 returns, but also to have filed the annual return of trading details at the end of the year. So when you click through on your tax clearance cert, if these aren't up to date, you will have to file them before you'll be eligible to apply. Revenue clarified 2 days ago that if you're not registered for VAT, you can still qualify for CRIS. So they gave the example of somebody operating a gym or a dance studio whose turnover was below the VAT registration thresholds. They will qualify. So while there's a requirement to be VAT compliant, by being under the VAT registration threshold, they'll be to be VAT compliant. Deep for those of you who have read the guide, deep in the back pages almost of the guide, there are 2 other conditions which require you, for eligibility rather. One requires you to ensure that you will go back trading after the lockdown period, and the other one says that you must have operated but for the restriction. So not going to support businesses who are already in financial difficulty in the start of the process, perhaps of winding up their business or liquidations. And equally, they're not going to support business who perhaps are specific to a period. And to give you the example on that, if this scheme is still in place, and the suggestion is it will be in February, and your business is selling Christmas trees, it's highly unlikely that you would be able to go in and make a claim for your business trees in February, because you're not going to be trading straight after the restricted period lifts. As I mentioned there, debt warehousing does not affect your entitlement to this scheme. Revenue have given a lot of examples inside in the guide, and it's difficult to pluck out any one or two that might be relevant to the audience today, but we've just given an example or two examples here of how the scheme might work, because the individual businesses have different issues. So the example is given here, and I suppose the first caveat in all this is that businesses that qualify are any entity type, whether it's a company, a sole tradership, or a partnership. Partnerships will just come to us as a specific issue that they've changed on that yesterday or the day before. So they've given the example that if you have, for argument's sake, two businesses operating in two different counties, and in the example, one of those businesses is in a lockdown period and the other one is in a county that isn't affected by a lockdown period, does the business or the entity still qualify for CRIS? And the answer is yes, it does. It qualifies for CRIS for the business premises in the county that is suffering from the restriction, provided the business activity from that property. So in the example there, it's given a car dealership where the total turnover of the company was 2.55 million. The bit that was relevant to the Donegal entity or Donegal dealership that was restricted in the example was a weekly turnover of 31,875. And when you work through the calculation, they will be eligible for a CRIS support of the order of 2,600, just short of that, per week for the period of the restriction. And in this example, it was hypothetical, but it was just giving an example of a 3-week period. It gives another example of, and we would have examples in this town where you have a property which has two trades from the same business. So one might be a supermarket at the back and a pub at the front, or vice versa. The pub being restricted access under the government guidelines, but the supermarket not being restricted. So the example given here is that provided the pub had its own separate entrance and it did not have, in this example, any turnover, it could have done takeaway up to 25% of the normal average for 2019. But if, in this case, the example they gave, there was no turnover, so you do qualify in this example for CRIS for the pub activity, even though the entity and the property rather has a second trade operating out of it, which is not restricted. So there's about 20 different examples where they try to cover all the bases in the guide itself. So it is useful for members who have not straightforward criteria to have a quick look at that guide in the first instance. They do spend a lot of time defining turnover in here, and I suppose for the reason being that our nature is to try to make sure that the square peg can fit into a round hole if that's at all possible. And just if there's grey area, it's to exploit that to your advantage if that's possible. So Revenue have gone and been very specific in what they consider to be turnover. So they're saying the turnover when you look at 2019 is a net of that figure based on accounting rules and definitions in the Companies Act. So it is the turnover that will be in your financial statements or in your sole trader accounts. And they are saying it's for calendar year 2019, as I mentioned earlier on. So for those of you that account for things like the VAT on a cash basis rather than an invoice basis, don't just take your return to trading details or regross your VAT. You need to go back to the accounts and do the calculation. You need to also consider whether or not certain grants are considered to be turnover in the income section, and there is a requirement to fill in non-VATable income in your sales. A point that came across, which I think is going to surprise a lot of people in yesterday's guidance or on Tuesday's guidance, is that where a business has been restricted and it decides to sell online, that online selling should be attributed to the business premises when calculating whether or not you meet what I'm calling the 25% test. So the test that says you must be less than 25% of your 2019 turnover in the current lockdown period on a week-by-week basis. So for those businesses that have been creative and have decided to set up their online businesses, and we're coming into a Christmas period, so we would have a number of clients who will be doing their best to try to sell online. They can't wait till the 1st of December to be selling their wares. They have to add that to their turnover as if it was from the business premises when comparing it to the turnover in 2019. So I think we're going to find that a lot of businesses will be thrown out of the scheme as a result of that. As I mentioned, the figure that revenue, and this is what they've said in their guide from 2 days ago, they're going to go off and do their own homework on this and see what you have filed in your Form 11s or your CT1s for companies. You would have listed your turnover in those tax documents, and they would already be filed or submitted. So revenue are going to do their own reconciliations there. For new businesses, they have come out and defined a new business as a business that started after Stephen's Day on or after Stephen's Day last year. And they're allowing you to take the period from commencement up to budget day, which is 12th of October this year, and divide it by the number of weeks to work out what your comparative average is. There was a lot of, I suppose, complaint back to Revy and lobbying in the last week or so from the Accountants Institute, etc., on this, because during that period we had a significant amount of lockdown on those businesses. So revenue are allowing those businesses who have to use a basis other than 2019 as a calculation to exclude from their calculation the turnover figure for periods where they were locked down. And what they're saying by that is that you must have had no turnover in those weeks. So for a number of businesses that may have started in January or February of last year, were told to close from March right through to June, they can exclude that period when they divide by the number of weeks, provided that during that period it was made. So how do you go about it? Put on the country and western music, put on the boots, dust them off, and get in the mood, because it's a two-step process. So step one is a registration process, which is open from Monday of this week. And step two then will be a claims process, which will be open from the middle of November. This is the screen for those of you seeing it on mobile phones. Apologies, but this is the screen that you'll be faced with when you go through the registration. So you go into your ROS, down to the registration section, and there will be a reference in there to register the CRSS. What slows down this process of registration is things like the air code for the business property, the average weekly turnover for 2019 if your accounts aren't prepared to a December basis. And revenue also wants you to fill in the VAT on your sales for the calendar year 2019. So they want to know what's called a T1 box for those of you filing the VAT returns. So it slows down the process of gathering the data. And obviously, as mentioned, you must also have the tax clearance certificate. And before you escape and get your registration, you also must make a declaration. And the declaration is that you believe that you're eligible for the scheme and that you're going to keep the paperwork. And that's an important issue, I suppose, with all of the schemes, whether it's the eWiz or the CRIS. You must keep paperwork to support your calculations, because the evidence a lot of you will have seen over the last month is that revenue, while at the start they said light touch regulation on this, everybody who entered the TW or the TR, SS, everybody got a letter or possibly two from revenue, checking eligibility, asking for supporting information. And we're not out the gap on that one yet, because there is still a requirement which revenue will shortly be writing to businesses to tell them how much they've over or underpaid or received during the period. The claims process, as I said, is not open until the middle of November. You will have 8 weeks from the start of the claim period to make a claim. They are making references to each claim period being effectively a lockdown period. So while you may make one claim, and the current claim period would be, you're allowed merge from October, 13th October through to 1 December. After that, if we have an extension or a change in claim period after the 1st of December, there will be a need to go in and make another claim. Just on partners, there was very confusing guidance given initially on this, so they have now changed the guidance and said that the precedent acting partner can make a claim on behalf of the partnership. And once again, you'll have a declaration to complete to go through that process. So that's essentially what's in there. There's a lot of detail. You'll need to talk to the accountants and tax advisors before you're 100% certain that you'll get through that process. I'm conscious, I suppose, on time, but we will have room for questions and answers. Second thing we just want to touch on is the tax debt warehousing scheme, which has been in place now since the start of the year. There's been a number of changes to this. I think from our earlier slide, there's been 5 revisions, which is 6 different guides that we've had to look at. And most recently, they added on a few taxes. So for most people, I think you'd be familiar at this stage as to what taxes go into it. So for February onwards, since the start of this year, your VAT and PAYE, employer PAYE was eligible for the scheme. The TWSS reconciliations, which you'll be getting to revenue shortly, again, that will be eligible automatically for the warehousing. And there's a small few changes in an income tax, which I'll cover. So the existing taxes, if you're an SME, which most people on this call would be, you automatically qualify. You don't need to make any applications or apply. The warehouse debt is effectively unpaid debt, and it will sit on your ROS as an unpaid liability, but it doesn't affect your tax clearance search, is what revenue have told us. We've had a few cases where people have had refunds subsequently, and they look for the refunds, and revenue incorrectly initially allocated the refunds against outstanding taxes. But under the scheme, you're actually entitled to keep your refunds. So for those of you who may have had refunds and didn't get them back, you can, under the scheme, go back in and ask to get those refunds. The interest rates, again, I think most people are familiar with it. It'll be the lockdown period plus 2 months. So before the most recent Level 5 announcement, pretty much all SME businesses were allowed to put their January-February 2020 VAT right up to their July-August 2020 VAT into warehousing. So they would have gone back in business sometime in June, and they were allowed to add 2 months to that for their VAT period. So you had effectively 8 months, of which 3 or 4 of them would have had 0 in any event because of the lockdown. But that's the amount of VAT that you can put into the scheme. The scheme then warehouses that liability for a 12-month period. And after the 12-month period, there's a 3% installment interest rate applied. That bit that people are asking us, when do I have to pay this back? I'll just give an example in a second, because it has changed the amount that you can put in, or the returns that you can put in, so the end date has changed. But there is a process which we have yet to see, which is the repayment plans that will need to be filed at some stage, late 2021, early 2022, where you're engaging with revenue to work out how much you can afford to pay them and keep your current taxes up to date. The guidance around this is all driven by the government roadmap for reopening society and businesses. So that decides whether or not your business qualifies. 1 second there, excuse me. So for those of you, and this is part of the stick that comes with, I suppose, warehousing. For those of you who may have under-declared taxes, either by error or otherwise, revenue are saying that now is the time to make your self-corrections and your unprompted qualifying disclosures. Because if you enter the warehousing scheme and you have outstanding taxes, which are subsequently discovered in either an inspection or you could hand up later on, you will be thrown out of the scheme and you will have full statutory interest applied during the period of the warehousing as if warehousing did not apply. So for any of you out there that intend applying for warehousing in the installment arrangement, just check to make sure that the skeletons of the closet have been corrected before entering the scheme. So the example given is, again, Donegal. For some reason, revenue have a perchance for picking on them as the example, but certainly there's a lot of examples in Donegal businesses in both sides. In this particular example, John, self-employed individual retailer, working in Donegal, was filing his VAT returns to date until the lockdown, can now warehouse his January, February VAT right through to July, August, it being the extra 2 months. He basically doesn't have to face up to paying any of that until September of 2021, or at least that's how things stood up to about 2 weeks ago, almost 2 weeks to the day, in fact. What happened then at a country level is that we then went into level 5, so John had to close his business yet again. So what does that mean for John and for a lot of our high street traders in this town? What it means is that you can now warehouse your VAT from January 2020 right up to February 2021. So if you get back trading, and hopefully we will again on the 1st of December of this year, and hopefully things stay going well for January, February, you can warehouse all of those liabilities right up to the end of February 2021, and you can take a whole year at 0% interest in that warehousing process, provided you meet the other criteria we've spoken about. You then enter into your payment plan with revenue, and that would start from March 2022. So for those that are eligible for warehousing, certainly there's every justification for taking it up. The important issue is that you stay tax compliant. In the budget then, there was an announcement around income tax and premium tax for 2020 that they could be included into the warehousing. There are, obviously with this little carrot, there are a couple of sticks that come with it. One is that you must have paid the correct premium tax in the 2019 year. So you have to go back to October or November 2019 and identify whether or not you met the minimum preliminary tax payment for the 2019 year. And if you did, you are eligible to put the balance of your 2019 taxes and your preliminary tax for 2020 into warehousing. You must make a declaration at the time of filing a Form 11 that you wish to do that. And for those of you that have filed your Form 11s early or have not filed them yet, you have up until the 10th of December this year. If you have filed already, there is a phone number that you need to ring. It is not a low call or free phone number. So just be mindful of that. Could be left on hold for a while, but you need to let the Collector General know that you wish to park the income tax for 19 and the prelim for 2020. They've given examples again of how that works. So the income tax scheme is running separate on an installment arrangement to the VAT and PAYE scheme. And why? Because the dates are different. So in the example given, John was a good guy. He paid the property improvement tax back in 2019. He had a good year in 2019, so he's a big liability for 2019. He also wants to park his 2020 prelim. He's allowed to do it because he has been tax compliant, etc. What does that mean in real terms? It means that the balance of his 2019 taxes and his prelim for 2020 can be parked, and he won't have to face into paying that until the 11th of December 2021. And at that point, he can enter into an installment arrangement in effect at 3% interest. And again, revenue will do these on a case-by-case basis, so there's going to be a significant amount of time involved in bringing businesses through that process later on. Just watching the clock again, so a little bit tight on time here. There was a scheme for other taxes which weren't specifically related to lockdown and COVID. Deadline was 31 October. There was a stick going with this one as well, I'm afraid, which said that the installment arrangement, while it was advertised at a high level at 3%, you had to pay 10% right up to the point of the installment date. That the 3% only covered you for the installment. So for those of you that entered that scheme by the end of October for arrears of, as it's listed there, all taxes, you would have paid 10% up to the point of the installment and 3% thereafter. It did simplify the process. It was a 60-month workout as opposed to the 24-month, which was the previous installment arrangement. And for those of you who are in existing installment arrangements, you are already benefiting today from a 3% rate rather than the 8 or 10 that was applied at the time. So that is, I suppose, the starter and main course effectively out of the way on the presentation. We were also asked, and I am conscious that I'm flying through this in how quickly I'm speaking. I hope I'm not losing people. We were also just asked to have a quick look around cash flow management, because it's an issue that has surfaced in a number of surveys that Jenny has done with members. It's a critical issue. What we just want to take a look at here is probably specific to retail, where is the cash wastage, specific to services, where is the cash wastage, and then for businesses, and the inquiries that we're getting is, should I be borrowing money, how much can I afford to borrow, and is there a simple way of doing this? So we'll give an example of just what I call a repayment capacity review. The biggest wastage in most businesses actually is management practices, but I'm not going to cover that today. I think most of you will know where weaknesses may exist there. Stock for retail businesses tends to be where the majority of their money is locked up. A very simple key performance indicator that we would ask our clients in the retail trade is, do you know, or are you operating to a gross profit per cubic meter per period? And I'm sure you're all nodding in agreement that that's exactly how you run your retail trade. But that's essentially how you make profit out of a retail business where you're selling product. So if you just think about what's happening there is you have an amount of space available to sell that particular product. The more that product turns over at the best margin in a period is actually how you make money. So businesses need to go back and look at where those issues are that might cause that profit level to be reduced, which has a cash flow impact. So it's about identifying what are the slow moving product. It's about knowing how long it takes to get that product from a warehouse onto your shelf so that you don't need to be carrying excess amounts. And it's about looking at the touch points in those processes to go back and say, well, who does the ordering? What are they ordering? Why is it being ordered at this time? Why is that quantity being ordered? So there is no simple solution, but there is a need to stand back from what you've been doing. And if you find you have cash locked up for stock, you need to be doing these things. As I mentioned, we're here in Trust Street 19 years. I'm 29 years working in practice as it happens. And technology has moved on a lot in those 29 years. So the cost of artificial intelligence today to allow you to access some of that data is much more affordable. And if you had surplus funds and you don't have artificial intelligence or automated technology, that's something the business need to consider and look at. We're encouraging clients at this stage to look at, obviously, their list of suppliers, to negotiate terms with them. You've got to just keep checking. That's what it is. There's no silver bullet on these things. It literally is, you have to do the heavy lifting. It's not just about sales here, it's about management. And we would say that in periods where we have restricted trading, sales forecasting is important because that drives the level of stocks that retail businesses need to carry. For those that are not selling product but are selling time and services, the second issue outside of bad management practices tends to be around credit control. So we're a nation of, I suppose, credit givers, but also discount takers. And as a result, those that give credit tend to trust the customer that they will pay on time. And if there isn't processes and procedures in place to follow up when they haven't paid on time, that debt tends to get bigger, and that's where your cash is locked up. So regular management reporting is what we're saying in here. In some cases, you'll have to restrict access or restrict trading with certain businesses and entities. A weakness we find is actually reluctance to ask. Sometimes people are good at sending out the statements and emails and reminders, but a lot of time people forget that picking up the phone might be the most effective, or calling into the customer and saying, by the way, I'm in the area, can I have a check, please? So it's a whole credit control issue. We could probably do a whole webinar on each of those themselves. I just wanted to give you a touch point on those. On the financial stuff and the repayment capacity that Jenny's asked me to look at, I'm not going to go into the details. There is good finance offerings out there at the moment, cost-effective finance offerings out there. They may or may not be relevant to your needs, but certainly talk to the accountant in that regard. What I am going to just quickly look at in the next two slides, and we are coming towards the end of the presentation, is what I call a repayment capacity review. And every business should be able to do that themselves. And we will be certainly at the slides afterwards for people to look to see what is, for those on the small screens, what exactly is in that. Things like financial projections and sensitivity models are relevant for certainly for the next 2 years. I think businesses should be putting those in place to know the level of activity that they need to generate in order to cover their overheads. And in some cases, there'll be difficult decisions to make. For those of you that are in difficulty today, you really need to be doing weekly cash flow forecasts. So you should be breaking it down into smaller bites, not doing monthly projections, but weekly targeting, ideally rolling out 6 weeks. You should know the bills that are coming up that you're going to have to pay, whether it's your insurance is due for renewal, your loan repayments are falling due. So you got to break it down into smaller bites. And for those of you considering investing in plant, etc., we're saying make sure there's a return on investment. So your projection should be out this road. Some businesses will need some assistance on debt restructuring, and we're just in the example in a moment, just take a look at what level of cash you could free up in debt restructuring. The honeymoon period that we've had on moratoriums is effectively over for the majority of businesses. So for those who are engaging with their banks now at the moment, it most likely is on mortgage or debt forbearance rather than the scheme which was available, which was a 6-month moratorium without any issues. So again, apologies on the small print on this, but what we have on the screen here, if I get the mouse to work here, the mouse doesn't want to work, does it? Anyway, what we have on the screen here, we have, oops, not too far. So now it's working. We have your typical profit and loss account on the left-hand side here. So in this case, it's just a restaurant with a turnover of 350, leaving behind, up here, sorry, leaving behind 47,000 of profit for the year. Sole trader, what we want to do is populate the document on the right-hand side to see what capacity this business has for borrowing. So that's the next slide, which basically says you take certain figures from that profit and loss account, which we've highlighted. You start with your profit. There are certain items you didn't write a check for. So you didn't write a check for depreciation. You didn't write a check for loan interest, but you did have the full repayments, and we'll have the full repayments further down. But this is about trying to identify what your business can generate in cash. And if you're a sole trader, out of that cash, you obviously paid things like your drawings, your taxes, and your pensions. And what we're trying to get to is a position that says, well, how much money is available for servicing debt? And this example, which I've highlighted here in red, this business with a 47,000 profit, after paying for their cost of living and the taxes associated with that profit, has 33,000 available for debt. We know they have existing loans because in this case we had 10,000 hitting the profit and loss account, and in this example they've got 200,000 with 10 years left at a 5% interest rate. So they have a capacity for new borrowing of 7,500 per annum. And to try to put that into English for you, that's what 7,500 would buy you. 20,000 over 3 years at 7%, or 50,000 over 7 years at 5%, or in fact 100,000 over 20 years at 4.5%. So the annual repayments on those, which are these figures here, will approximately equate to your 7,500. Now that's before you would do sensitivity analysis. How would you improve your repayment capacity? Well, one of the items in here was we had assets purchased from working capital, whereas we could have perhaps financed those. We might have decided to suspend our pension, and these would free up extra repayment capacity. We might tighten the purse strings at home. We might tighten the purse strings on some of our costs. So this is what businesses need to be doing. If you've got a negative figure down here, we're already in cash flow difficulties because it means that the business isn't generating enough money here to pay all of these bills. So the bit at the very bottom, which I know a lot of you on small screens won't be able to see, but it says, well, if we did a debt restructure with a repayment of 33,000, what's the maximum we could actually borrow, assuming all other borrowing criteria were met? And that 33,000 in this example would actually service 420,000 over 20 years at 5%. So again, it's just giving examples of the businesses that are out there that may be under some degree of difficulty, that a restructure of your finances could free up significant cash flow, and it's something to engage early in those conversations. As I said, engaging early, the other point I just wanted to make to people, because we know and we already have started some conversations with businesses, not everybody is going to make it through the current period, and they need to have accurate information in front of them to be able to make the right decisions. For those of you operating in company structures, while you may own the company, company legislation is very strict, and there are, I suppose, exposures in there that can get you prosecuted if you don't follow the letter of the law, and that law is company law. So there's scenarios like reckless trading and prohibited direct loans that businesses need to be aware of. And the message I'm just leaving there is to document your decisions and seek professional advice. So that is a crash course on probably 5 minutes over where I'd like to be. Hopefully there's still somebody left on the call. Happy to take questions there, Jenny.
We do, John. They were sent to me directly, actually. Just going to say, first of all, thank you really much. That was really comprehensive and really thorough. And sorry, I'm going to put back on my video. And I have to say that the examples were really, really helpful there, John. So thank you for those. You mentioned, as regards the CRSS claims, a precedent acting partner. Can you just describe there what that is, please?
So in partnership law, you're typically required to have a partnership agreement, and one partner effectively is tied to the partnership tax number. So it's the partnership tax number where you've allocated one of the partners, effectively the managing partner. Right? That's how partnership would work. But that's what revenue called your precedent acting partner. So it's the individual that's tied to the partnership's tax number.
Great. And the other question I have, and if anybody wants to pop a question into the question and answer box, you're more than welcome to do that now. The other question I have is about, you mentioned there about sales forecasting, and obviously that's, it's a practical thing to do. However, If you are, we'll say, a service business and your consultancy has been transferred online and you're still trying to establish demand, or you might be a retail business and now it's a whole new world out there as regards retail, or if you're a new business with no history, then it's kind of daunting to try and predict some type of sales forecasting. So how would you suggest that people could get help when trying to do this accurately, as opposed to just stabbing a number in the air and going, right, sure, we expect it to be that?
I suppose, what are we trying to achieve when we're looking at forecasting? We want to ensure that we get to a break-even scenario. So for a lot of businesses that you've just described there, it's actually what we call a bottom-up approach. So start with the expenses and saying, this is what needs to come in order to cover my liabilities. And then you monitor it. The income level that will set effectively is setting a target, right? If we're not hitting that target, and the idea behind it is to have a target up and lights effectively for you. If you're not hitting that target, then you're going to have a deficit week by week, month by month, and that's a rolling cumulative figure. So when we talk about forecasting, right, a lot of the established businesses will know based on trends of certain times of the year when their customers essentially are going to be buying. For new businesses, it is difficult, but the purpose of the exercise is to put a figure out saying, what was my target for this week or this month? And if we're falling behind, we're eating into our reserves. And we need to know then, have we adequate money put aside for those reserves? Do we need to go and raise finance? Do we need to get restructure? And these are the questions that it will prompt. And all accountants are skilled at doing this. So it is about coming back to the accountant and making sure that you get that service.
Okay, and again, kind of in that same vein, John, is it prudent that we'll say when doing forecasting for 2021, that we assume that there's going to be a number of other restricted times? And so if my business is affected now because of different, from level 3 upwards, should we forecast that there be maybe 12 weeks in the, quarter 1, quarter 2 of 2021 where we should input similar type of data or nil income or whatever, similar to this year, what we've experienced, or do we live in hope? Just wondering, what's the most practical assumptions to make?
I think it's almost the same point to some extent. Businesses should know what the costs of operating are. So they should know whether they're rolling forward 6 weeks or 52 weeks, what costs they're going to have to open their door. So on the 1st of January every year, if you're a December year end, you know what your insurance is going to be. You should be putting aside budgets for things like your marketing. And that's one that most people initially cut is marketing and training. But if you're not marketing and promoting, you're actually going to cut off your communication lines to your audience. And therefore, people forget about you. And they'll remember the ones that were in their face. So what I'm saying to people is that you need to do a projection, right? And earlier on this year, there was a scheme which the Chamber were involved in administering as well, where the local authorities were giving assistance to help businesses with a continuity plan to do these cash flow projections. Every business should be looking to do cash flow projections, I would say, because it does nail down the operating costs and it sets the targets. By doing it, and if we are pushing out into next year, by doing it on a month-by-month basis, you will have a rolling total. You can change from budget to actual as the months go by, and you will see how things are faring. And you will also see when your reserves are getting too tight, because you'll be projecting it forward and expecting something to happen. So I wouldn't go stab in the dark, absolutely not. No, I think it's important that people do and there are simple Excel spreadsheets out there that most businesses and accountants will have and use. It doesn't have to be overly complex, but it is important to do it, absolutely.
Fantastic. John, that's actually a great segue into, we'll say, resources that are there for people. And you mentioned the business continuity vouchers. I thought that was an excellent initiative that the government gave through the local authority. It really helped people be able to make plans for their business to survive. So wholeheartedly agree with you there that people got an awful lot out of it as regards just the practicalities of trying to plan their business during COVID. And also there are more resources that are available to businesses, like the trading online vouchers as well, which is delivered in the same way through local enterprise office. And local enterprise office offer different grants and mentors and training, and really each business should engage with the local enterprise office directly. Also, gov.ie and revenue are great resources as well for information that people might be looking for. And so I think, and that information often is very clear on those sites as opposed to coming hearsay from different areas. John wants to say a massive thank you for that. I think we have a lot to digest there, but hugely helpful. So very nutritious information. And this is somebody just said thanks for the sound advice. They're very helpful. This has been recorded, and we're happy to publish this on our website and also on our YouTube channel as well. And we can give links to attendees and those who didn't get to attend today. So John from JBW Accountants, thank you so much for today.
Pleasure, Jenny. Thank you very much.
Thank you. Thanks to the attendees.